hear you.
Aha. Now, the case here, what we have is a case of purchases, right? Whereby Omi purchased 80% of Rua, right? That one is straightforward. Am I right? Right?
Right.
Yes, sir.
So Omi purchased 80% of Rua. What date is this? May 2023, right?
Yes.
May 2023, question 1.
Yes.
What's the name of the company? Omi, Rua, and Imiri.
Mommy.
Rua and Imiri group accounts, right?
Yes.
Okay. Now, group structure. Let's start with the group structure. So for the group structure now, please, can we see the screen? Can we see the Excel sheet? Or do you need me to zoom in a bit?
Yes.
Which one is yes?
Yes.
Zoom in or you can see it.
I can
Yeah.
see it.
Okay. Now, group structure is that from Omi
Yes.
to Rua, right? To Rua. This is Excel sheet. We can't use that. Omi to Rua is what percentage? 80%,
80.
right? Then
Mm-hmm.
Omi to Umiri, how many percent? 40%, right?
Right.
We have the question, right? I'm not
Yes.
looking at the question anymore. I'm looking at my
Okay.
Excel sheet now. I don't have the question with me.
Okay.
Then also we have what's the next one? Rua to Umiri
Millie.
is how many percent?
25%.
25%. And the last one is what? Omi. Now this Omi to Rua, Omi to Umiri is a direct ownership, right?
Yes.
Direct ownership. Now, direct ownership. But what about the indirect from Rua
Mm-hmm.
to Umiri? Because ordinarily, Rua is a subsidiary to Omi. So whatever Rua has in Umiri, we can have an indirect ownership of that Umiri. Am I right?
Yes.
So how do we get it? Now, if Omi has 80% in Rua and Rua has 25% in Umiri, what do we have? That means 80% times
And
25% will give us
25.
the indirect ownership.
0.2.
Do you understand?
Yes.
Aha. So indirect ownership. So Omi to Mmiri will now be 0.2, right? 20%. How do
Yes.
we get that 20%?
20%.
Now, how do we get the 20%?
80% times 25%.
80% multiplied by 25%, right?
Yes.
Indirect ownership, right? So what is the total ownership of Omi to Umiri? I don't know if you understand. I have 40% ownership, direct ownership, and I have 25% indirect ownership in Umiri. Do you understand that? Hello?
Yes, sir.
Yes, sir.
Yes.
Okay.
Yes,
So
sir.
automatically, total ownership in Umiri, total ownership of Omi to Umiri is what now? What is it? The first direct ownership is 40%, right?
Mm-hmm.
Plus 20%. right? And that gives me a total of what? 60%.
60.
60.
So you know, I was saying it then that we still need to look at the group structure before we decide whether we have control over Mmiri or not. So automatically now, Omi Limited has 80% ownership in Rua and 60% ownership in Mmiri, right? Is that correct? Is that correct, please?
Yes. Mm-hmm.
Please, I hope you understand what I'm saying.
Mm-hmm.
To Mmiri, we have 60%, and to Rua, we have 80%, right?
Mm-hmm.
Okay, that's fine. Now, if this is our group structure, what's the next thing we have to do? What's the next thing, please?
Goodwill computation.
Okay. And our goodwill computation, how do we get that? Yes. What do we need for our goodwill?
Purchase consideration.
Purchase consideration.
My NCI.
Okay.
And the net assets for the
Sorry,
subsidiary.
sir. Is good. Hello, should goodwill come before net asset list?
Yeah. We can do goodwill. We can do net assets.
Net
None of
asset before
anyone can
goodwill.
come first, right? Now, are we using, is the company valued at net assets? That's the question. So let's check the question. Let's do the net assets, right? Now, we purchased Rua at 80% when the retained earning was 400 million. The fair value of the net asset was 2.84 million. So they gave us the fair value for Rua, right? They gave us fair value, Rua at fair value of 2.84 million. Any fair value adjustment related to non-current assets and this net current asset had been realized by November 30, 2020, right? So what do we have there? That means we don't have the structure given to us. They only told us that our net asset. But of course, if you want to compute the net asset, we can compute the net asset, right? Am I right?
Yes, sir.
Aha.
Yes, sir.
So what would be the net asset if you have to compute it? Well, they gave us the fair value. Is that not so?
Yes.
But for us to do the net asset, let's calculate the net asset again. Let's calculate the net assets. Now the net asset of each of them. But don't, right? Are we there?
Yes,
Hello?
sir.
Yes.
Can hear
Okay.
me?
Yeah.
We are
Okay.
here. We are here, sir.
Okay. So let's do the net assets before the goodwill. What will be the net assets? Net assets of subsidiaries, right? So what will be the net asset of the
Yes, sir.
subsidiaries? Yes, what will be the net assets of the subsidiary? What are the subsidiaries? We have the net asset at date of acquisition, at date of consolidation, right? Am I right?
Yes, sir. Yes, sir.
Okay. So for our net assets now, the first one we have is we have three of them now, if I am not mistaken, right? Okay. Now, can we do the net assets of Omi to Emiri and at what percentage? Hello? Hello? Can you hear me?
Yes.
Yes, sir.
Okay. So
Can hear
what is
you.
the net
We are
asset?
hearing you.
What is the net asset of Omi to Rua? Net asset of Omi to Emiri direct, and net asset of Omi to Imiri indirect, because we not do Rua to Imiri. Am I right?
Yes.
Aha, we not do Rua to Imiri. So let's see. So, let's take this one. This is Omi to Rua PLC, right?
Yes.
Is it Omi PLC too, Abby? Because I've been using
Omi
Omi
PLC.
PLC to Rua PLC. Then also we have Omi
Lower
PLC
limited.
to Rua Limited, ba?
Yes.
Oh, okay. Omi PLC to Rua Limited. Then also we have Omi PLC to Imiri Limited or what?
Limited. Merely limited.
Okay, Imiri. And that's we have the direct, right? Let me put it in bracket. This is direct. And we have another one, which is indirect. Okay, so what do we have? Let's identify them. Okay, so we have for date of acquisition, at the date of acquisition or at acquisition, then at consolidation, right? And then
Yeah.
we have post acquisition profit, right? Are we together, please?
Yes, sir.
Okay,
Yes.
so that means I have this and I have this as well. So let's do them one after the other. Now, what are the assets we have? Yes. Okay, I thought you want to help me. At the date of
Share
acquisition,
capital.
sorry, ordinary share
Share
capital of,
share capital.
yes. How much is the share capital? At the date of acquisition of Rua,
2000.
2,000 in total,
Okay, okay.
right? In total, we have 2,400
200.
and retained earning was 800. This is at the date of consolidation, right? So we have 2,400 at the date of acquisition, right? Hello?
Yes, sir.
Now, we need to
Okay,
be
sir.
careful with this information. Let's go to the additional information. What does it say? The additional information says that when we acquired the ordinary share, the retained earning was 400 million. And the fair value of the net asset was 2,840,000. Right? I don't know if you understand what I'm saying.
Yes.
So 2,840,000 minus 400 million is 2,440,000.
Okay.
Right? But
Mm.
then now whether we have this or not, they gave us the fair value. Now, where fair value is given to you, do you need net assets at the date of acquisition and at the date of consolidation? Where fair
No.
value is given to
No,
you?
sir.
No.
No. Why? Because everything has been considered,
Summed up. Yes.
right? Everything has been considered, whether it's post acquisition or not. Now, the retained earning as at the date of acquisition was 400 million, right?
Mm-hmm.
But the retained earning at the date of
Yeah.
consolidation is how much now? At the date of consolidation, retained earning of Rua was 800 million.
Yes.
Abi?
Yes.
Aha. Now, So at the date of acquisition as well, our net asset, let me leave it here. Ordinary share capital is 2,000, right?
Yes.
And the
Mm-hmm.
share premium is 400, and then the
400.
retained earning is also
800.
400. No, 400 at the date of acquisition. So
Acquisition,
we have
okay.
the three asset. I mean, we have the three information. We have the share, ordinary share. Ordinary share is how much again?
2,000.
Did they call it ordinary share or share capital?
Share capital.
Let me use the name they use. Share capital at the date of acquisition is how much? 2,000, right?
2,000.
Uh-huh. What else do we have? Share premium.
2,000.
We also have share premium.
200.
What's our share premium?
400.
400. And what again? Retained earning
Return earning.
was how much? What's our retained earning?
800. 800.
800. At the date of acquisition. No, now 800 kwa.
400.
It's
Acquisition, 400.
400. This is it now. 400, right?
Yes.
Aha. So 400. These are the assets we had at the date of acquisition. All right.
Yes.
But they told us that if there is a difference, this one should give us 2,800. Right?
Mm.
But the question now says that if there is any difference, the fair value of that net asset is 2,840,000. Am I right?
Yes.
2 billion. The question is in million. Oh, hey, I didn't even bring my denomination. The question is in million. All right. Now, if all of this, we have a fair value adjustment, right? Because our total must be how much? 2,840,000.
40.
840.
Yes.
But if you add all this together, we have 2 million. 2,800,000, 2.8, right? 2.8 billion. Now, the question is saying that there is a 40,000 there, that any difference between the net asset and what we have, any difference there is as a result of an adjustment, right? Any fair value adjustment related to the net asset is any fair value adjustment related to net asset, and this net current asset had been realized by November 2020. Let's leave that information separately. We leave that one first. All right. But we have a fair
Okay.
value adjustment, Abby, which is
Mm.
40.
Yes.
Now, at the date of consolidation, what do we have as the share capital? We still have 2,000, right?
2,000.
We have 400 here, and here we have
400.
800,
800.
right? So our
Yes.
post-acquisition profit ordinarily, we have this minus this.
0.
Consolidation minus acquisition, right?
Mm-hmm.
Okay. And then that will give us here, this is what we still have, right? So we have this
Mm-hmm.
one to be 40. Now, this 40, don't worry, I can clear it. Oh, thank God we are using Excel, right? Until we get the information. So this is what we have for now. Now, for Mmili, Omi to Mmili, what do we have there? Yes, was our net asset at date of acquisition?
Mm. 200.
Hello,
Hi.
what's our fair
Coming.
value? I mean, what's our asset at the date of acquisition for Mmili, whether direct or indirect? What do we have? Now, they will have the same information actually, and the same information in the sense that the net asset of Emily is this 800, 200, and they have a revaluation reserve here. But let us check if they have revaluation reserve as at the date of acquisition as well, right? But the share capital and the premium is 800 and 200. right? 800 and 200. Now, let's go into when we purchased it. So when we purchased it, we purchased 40% of RUA, the retained earning. No, OMI purchased 40% and RUA purchased 25% ordinary share. The retained earnings of Emily on that date was 200 million. Do you understand?
Yes.
Aha. The retained earning of Emily was 200 million. And those of RUA Limited were 600 million. What does this mean?
Hmm.
Can someone tell us what this means? It means as at 31st December 2018, this is the value of RUA Limited, retained earning in RUA Limited. But the one we are preparing now is as at what date?
November 2020.
November 2020 is the consolidation, right?
Mm-hmm.
When did we purchase it? We purchased it in 2018, right?
2018, yes.
Aha. But we purchased RUA in 2017 December. A year later, RUA's retained earning has gone to 600 million. As at the date we purchased RUA Limited in 2017, RUA Limited had a retained earning of 400 million. But a year later, the retained earning had gone to 600 million, right? Do we understand that, please?
So
Yes,
I did
ma'am.
not see 2017, no. Okay,
This
I've
is
seen it, sorry.
2017 here.
I've seen it, yes.
That's when we purchased
Rua.
RUA.
Mm.
Shall we proceed now?
Yes, sir.
Okay. So the retained earnings of RUA Limit, of Milli was 200 million, right?
Mm.
Okay. So that means the retained earning was 200 million. And they didn't tell us that there was anything like this revaluation surplus as at when we purchased it. But we now have a revaluation surplus at consolidation, right?
Mm.
Okay. Now, so what else do we have? Do we have any fair value adjustment? No, nothing of such. They did not say anything relating to that, Abby.
No.
Okay. So anything I don't have here, let me just put it here. Now, then at the date of consolidation, what do we have? At the date of consolidation, 800, 200.
That's
Then we have
200.
revaluation reserve of 280. Abi? And retained
Yes.
earning on 240.
Maker, please, can you mute your mic?
Please help us. Revaluation reserve. So we don't have anything here, nothing here. Then here, what do we have for revaluation surplus? At the date of acquisition, nothing. But we had it at the date of consolidation, right? So at the date of consolidation as well, we have this to be 800, this is 200. Well, our retained earnings was how much? 240. The retained earnings should come before. Yeah. Revaluation surplus is 280 at the date of consolidation, right? And here we don't have any fair value adjustment given to us. Shall we proceed, please? Okay, I think the only person who has been responding is whom we asked to mute now. Sorry, we understand that the noise is not really affecting us, but those other people who are listening, it's not really affecting me because I am speaking. But those who are listening, it's affecting them, it's distracting them. That was why they asked you to mute. All right. Sorry. If there is a way you can keep the baby silent and then unmute yourself, please, because you seem to be the only one responding to my questions. The rest of them will do it occasionally. Okay. Anyways, let's continue, please. All right. Now, then for this one also, for our indirect, we will still have the same information here at acquisition and at consolidation. All right. Now, this is our net asset at the date of acquisition and at the date of consolidation. Okay, the next thing we have to look at is our goodwill, right? So what's our goodwill now? Yes, how do we calculate goodwill? 3. Calculation of goodwill. Yes, how do we determine our goodwill? Anyone?
The percentage holds in each of the subsidiaries.
How do we get goodwill? We say goodwill is what? Purchase consideration.
Plus net asset of the
Sorry. Plus what? Hello?
Hello, sir.
It's
Is it
Yes.
purchase
purchase consideration plus NCI minus net identifiable assets?
Okay. Purchase consideration plus NCI, right? Minus net asset at the date of acquisition. Please give me 1 second, please. 1 second.
Okay, sir.
Yeah, sorry everyone, I'm back. Hello, can you hear me?
Yes,
Yes,
sir,
sir.
we can hear you.
Okay, so sorry about that. Now, going back to the question. So for the question now, we have to do our goodwill, right? And how do we get our goodwill? We do the goodwill for all of them too, right? So what will be the goodwill now? Purchase consideration. What's our purchase consideration? What's the purchase consideration? Yes. What will be the purchase consideration, everyone? Purchase consideration is the amount we paid now. Abi, is that not so? Hello?
Yes.
How
Hello,
much
sir.
did we pay? Yes, sir, I can hear you. Go ahead.
Yes, sir, which is, I think, the investment.
And what is it? How much
Investment
did we
in
pay?
rural limit
2,560.
2,560 million.
2,560 million. It's not in the additional information, right? Then that means we can see it here.
No,
Investment in rural is here. 2,560 million. It was what we paid. Abi?
Yes, sir.
yes, sir.
So we paid 2,560 million for rural. And for Millie, how much did we pay? We paid 640, right?
640.
Aha. So consideration. Now, we are doing the three of them separately as well, right? Am I right?
Yes, sir.
Okay. So, uh, I'm thinking of a way of stealing this thing one after the other. One, right? Omi to Rua, Omi to Emiri, which is direct, and the one for indirect. If I pick this one, okay, this is what I'll do. Omi to Rua Limited. I'll pick only the word and not take the whole thing. Then this one, the one of direct, will also be here, right? Let me have, oh, what happened to my Excel? So I'll have 2 pages for that. Then this one also is the direct, and this is for the indirect, right? One, two, one, two. So let me do this. One, two, three. Okay. Now, what is our consideration again? What's the purchase consideration?
2,560.
How do I forget this Naira sign? 2,560. And how much did we pay for uh Omni to Emily? Our direct was how much?
640.
640.
40.
Uh-huh. And the indirect will be how much? What will be our indirect cost?
400.
Are you sure we are picking 400? How many percentage of RUA do we have?
80%.
80%. So which means whatever RUA does, 80% of it is what we did now.
Yes, sir.
So which means out of that 400, only 80% of the 400 belongs to us, not the whole 400. Am I right?
Yes, sir.
80% of the 400 is what belongs to us. So what's the 80% of 400?
320.
Can someone please confirm that? And if you don't understand what we are doing, please let us know.
Yes, sir, it's correct.
You understand how we
320.
got 80% of that 400? All right? Because Omi PLC to Umeli is not a direct purchase. In actual sense, it was Rua who purchased Emily, right? Rua paid that 400, not Omi. I don't know if I'm making any sense.
We are with you, sir.
Aha. So Rua paid 400, and 80% of whatever Rua does is for us, right? So that's why we are taking the, what's it called? The 320. All right. Then also after that, the net assets at the date of acquisition, Abby.
Yes, sir.
So what's the net asset? Or what we can say net asset, Abby, and add NCI or what? Is it NCI?
Yes, sir. We'll add NCI before we list net identifiable assets.
Okay. So we had NCI and less net identifiable assets. What is net identifiable asset? What is NCI? Okay, NCI is not controlling interest. Please don't let me mix it up. Now, what is our NCI? Hmm?
Um,
What is our NCI? Yes, what will be our NCI?
20% of 2840.
20% of 2840. Thank you, sir. So what is 20% of 2840?
568.
Sorry,
568.
568.
Yes.
Okay. Now, the 2840 is at the date of acquisition, right? Now, 80% is our own. Another way you can do it is, don't forget, you add NCI and let net controlling interest. What do you call it? Net assets, right? So add
Okay.
NCI. Add NCI. Our NCI is what? 568, right? Am I right? Am I
Yes,
right?
sir.
Yes, sir.
Uh-huh. Then let's net assets. Since we've prepared our net assets, we don't need to prepare it again. Our net asset for this one is 2,840,000, right?
Yes,
Two
sir.
million eight forty minus 2,840. And what about the one for Emily? What's the NCI date of acquisition? What's the net asset at the date of acquisition, Seth? This one is 1,200,
1,200.
right? Whoa. Okay, something happened here. Okay. So net NCI of this one is 1,200, right? And what is the percentage we are taking? What's the NCI? The net asset is 1,200 minus 1,200, Abby, minus, no, not this one. In fact, I'm supposed to use just one page here. Since I'm not doing the calculation again, I'm supposed to use one page. Okay, that's fine. Yes, what do we have, please? Hello, is anyone there? I'm trying to do a
Yes,
shortcut. Oh. And what's our NCI? What's our
480. 40%
NCI?
of 1, 2.
Yeah?
40% of 1, 2.
Uh-huh.
480.
480. This thing is just making it big. Okay. Oh, my consideration has gone. Consideration again, please. What did we have as the consideration? Can I still remember? 2560. I think I remember
Yeah, 60.
40,
2560, 640, right?
320.
And
320. Yeah. 2560 is the first one. 2560, right? The second one is for direct 640, Abby. And the other one is 320. Yes, our NCI, which is I think what's the 20% of 2840? 568.
568.
Is it 568?
Yes, sir.
What's the 20% of this 1200?
40% of 1 to 400. 480.
Is it 40%? What's the direct we have? Direct ownership we have. And direct ownership is 40. The
It's supposed to be
indirect will be
60.
60. The indirect will be 60. Do we understand, please?
Yes, sir. That's 720.
720. And the last one is what? Yes, it will also be 720 now. Is it not the indirect? And our net
Why?
asset here is 2840. Sorry?
Sorry, why are we using 720?
NCI. How much is our direct ownership to Imiri? 40%. Is it not 40% we have?
40% of 1,200 is 480.
480 is
I'm
480. That's
coming
fine, ma'am.
now. I'm coming. 40% is what we have, Abi.
Yes, sir.
Yes.
NCI will
Yes,
be
sir.
what? NCI will be 60.
60.
So 60% of your 1,200. 60% of 1,200
220.
is what?
720.
720.
720. Right? And this one also. Oh, what's the percentage of indirect ownership we have?
20%.
20%. So 80% belongs to NCI. Abi?
Yes, sir.
So 80%
Yes.
of 1,200 is what?
960.
960.
90.
And then we have 1,200 here as the net asset. Am I right?
Yes, sir.
Aha.
Yes, sir.
So what is our goodwill now? Yes, what's the goodwill? We have 288. We have 160. Oh, sorry. This one is meant to be minus. And we have 560. Is it really 560? Okay, NCI at the date of acquisition is 960.
So we have to add the 960 to 320.
And remove, thank you. Remove 1,200. Yeah. So that means we have 80, right? So this is our goodwill. Am I right?
Yes, sir.
Okay. Now after the goodwill, what else do we have? We calculate NCI, right?
Yes, sir.
What's the total value of NCI? The NCI at the date of acquisition, we've identified it, which is 568, 720, and 960. Abi, am I right, please?
Yes, yes, sir.
Okay, that's at the date of acquisition. Now, let's calculate our total NCI. So what will be the total NCI in milli? How do we calculate NCI? Number 4, calculation of NCI. Yes, how do we calculate our NCI?
NCI at acquisition plus NCI of share
Post
or post
acquisition profit,
acquisition.
right?
Yes, sir.
A
Okay.
share of
Yes,
profit.
sir.
Sir.
Sorry? What do you say, please? Wait, I think I need to bring. Do you all have the question, or do I still need to show the question? Okay, if you have the question, even if you don't have it, let me just have it again, because all this me twisting and twisting and twisting is tiring. So our NCI, what is our NCI? At the date of acquisition, what's the NCI? So we have NCI for RUA, right? For RUA Limited and for Emiri, Emili Limited, right? So what will be our NCI? NCI at acquisition is how much? We have it to be 720, Abby, and we have this one to be 960. Am I the only one in this class? Nobody is saying anything again, oh. Hello?
Sir, me, I'm lost. Though. Please, what about the 568? Are we not going to consider that?
Oh, thank you. Thank you very much. Now, our NCI for RUA is 568. NCI for RUA is 568. Hello, is anybody there?
Yes, sir.
Yeah.
So what is the NCI? Eh? Oh God. It seems we don't understand. Is it that we don't understand what we are doing? Let me get it first. We don't understand what we are doing on NCI. Do we understand how to get NCI in the first place? Do you understand how to get NCI? Huh? Hello?
Yes, sir. Yes, sir.
Do we understand how to get NCI?
Yes, sir.
Okay. Now, the NCI at the date of acquisition is what? What's the NCI? How do we get our NCI? I'm asking.
20% of
Sorry?
the 568. That's 20% of this two
Uh-huh.
export.
And this one, what is our total control of Emily? Our NCI at Emily, we have the direct NCI, we have the indirect NCI, right? If you had these two NCIs together, will it give us the same thing as having the NCI of 40%? Will it give us the same thing? For instance, 40% of 1,200 is what?
480.
480. But this one is giving us 1,680. Right? Now, what we want to do is that, don't forget, in our question, we have the we have the net assets, right? So before we even do the NCI, the NCI might not be gotten directly in this question. And why is that? Number one, Rua has a share in Emily, right? Am I right, please?
Yes,
Yes,
40%.
Okay.
yes, yes.
Now, what is their net asset at the date of consolidation? This one is 3,200, right? And Emily is 1,520. Am I right?
Yes,
Yes.
yes, sir.
Okay, now let's use that. Let's use that way first. Let's use this, leave this NCI at the date of acquisition on consolidation. We'll come back to that. Now, the net asset at consolidation. What's the net asset again? 3,200, and this one is what? 1,520. Right? Now let's come to what's this person called? Let's look at the trade that we have. The investment we have. Please, do you understand? Hello, do we understand?
Yes,
Millie
sir.
has
We are
an
with you.
investment. Millie has an investment in Rua, which is 400, right?
Yes, sir.
Now that investment in Rua of 400 has to be completely eradicated. Am I right? When we are
Yes, sir.
consolidating,
Yes, sir.
right?
Yes.
Okay, so investment in investment of Emily, I mean Rua in Emily is how much? 400, Abby. We need to remove this 400 from the 3,200 because this 3,200 now, this 3,200 we have here has that 400 in it. Do you understand? It has the 400 in it. So now, if we remove it, if you look at the cost again, all right, let's check our information if there is anything that needs to be removed.
The class is about to end.
If the class ends, please let's log in back immediately. Let's log in back immediately. All right, so that's it. Now, hello. Hello. Oh, sorry. Can you hear me, please?
Yes, sir.
Okay.
Yes.
Now, we are looking at if there is any information,
Yes.
right? If there is any information that will affect the financial statement, that's IS10, event after the reporting period, that might have an effect on this financial statement. Now, in the question, right, apart from this information one, we've used information one, we've used information two, right? Now, looking at information three, the group operates in an information technology sector, right? The costs incurred were formerly written off to a statement of P&L as incurred, but then reinstated when the related internet products were brought into commercial use, right? So that's like research and development costs. Now, the reinstated costs are shown as development inventories. The costs do not meet criteria of IS 38 for classification as intangibles, and it is unlikely that the net cash flows from this product will be in excess of the development costs. In the current year, Rua Limited has included 80 million of this cost in inventory, which 20 million relates to expenditure on a product written off in periods prior to December 2017. Hello. Now, if you look at this information, they said that this 80 million that we have included does not meet the criteria of IS 38 intangible assets. But we have included it in our financial statement. Am I making any sense here?
Yes, sir.
We have included this 80 million naira as part of intangible asset IS 38. And yet, we do not meet that criteria. The item does not meet the criteria. So what do? We reclassify it back. We remove it from the financial position and take it back to the income statement. Am I right? Am I right, please?
Yes, sir. Yes, sir.
Do you understand what I'm saying?
Yes, sir.
Do you understand what I'm saying? Do you understand what I'm saying there?
Yes,
If you
sir.
don't understand, just say it.
We understand. Let's look at it again.
Okay, so we are saying that in information 3, right? We have development cost, research and development cost. Now, this development cost has been capitalized. Initially, the costs were written off to income statement, P&L account. Do we understand? Initially, the costs were written off to P&L account,
Yes.
but later on we reinstated the cost, but then reinstated when the related internet products were brought into commercial use. Of course, when you have a development cost, research and development, you have to expense it until there's certainty that it will come to commercial use. Now, immediately it came to commercial use, they had a green light that it will come to commercial use. They did what? They capitalized it. They put it in the financial position. Now, they now said that the reinstated costs are shown as development inventories as part of our inventory. Do you understand? It's part of our development inventory. So, which means this inventory here, the development cost is part of it as part of our development inventories. Now, the costs do not meet the criteria in IS 38 intangible assets for classification as intangibles. And it is unlikely that the net cash inflows from these products will be in excess of the development costs. All right? It is unlikely, that is, you might not be able to sell that item. That is, your cost will always be more than your revenue. So definitely you can capitalize it. Am I right?
Yes.
Before you can capitalize an asset, before you can make something an asset, the future economic benefit must flow into that company, into the entity, right? Am I
Yes,
right, please?
yes.
Aha. So that is it. Now, yes, what else do we have? So this 80 million now, we have to remove it. All right? If you can just from here, now in the current year, Rua Limited has included the 80 million of this cost in inventory. So that 80 million, we need to remove it completely. Do we understand that now?
Yes, sir.
Aha. So we have development cost. Development cost of how much? 80 million. Right? Please, do we understand that?
Yes, sir. Yes, sir.
Okay. Now, what else do we have? Let's check if there's any other thing. Let's come to our question again. So we've taken information 3. Let's look at
I'm
information
sorry,
4.
sir.
Yes,
Sir,
ma'am.
I don't understand one thing. I thought maybe whenever we're calculating for NCI, we just do NCI probably as per statement, maybe share of profit. Then if NCI like for investment. So
Yes.
I don't know that NCI do have this kind of adjustment like this one you are doing now. Because if I
Yes.
was in the exam, I wouldn't know that I'm going to do all this. So, like from the question now, how do we know we are going to do this kind of adjustment to the
Now it's in
NCI?
the question. If you are doing NCI, what are the things you need? How do you get your NCI?
Um, as per acquisition,
Mhm.
um,
NCI
the
at the
share
date
of
of
profit.
acquisition, Abby.
Yes, yes.
And NCI at the date of what? Post
Post
acquisition profit.
acquisition. Yes.
Now, we are saying that your post acquisition profit in the first place is wrong.
Okay.
Do you understand now?
Okay.
The NCI of your post acquisition profit is wrong. Now, Your NCI, you can use at the date of acquisition and you can use at the date of acquisition and post-acquisition profit. If you add it together, it will give you your total NCI. But do you know that you can also
Okay.
get your NCI from information from your net asset at the date of consolidation? Do you want me to prove it that you can get it at date of consolidation?
Yeah, I don't mind though, yes.
Okay. Now, let's come to our Excel sheet. If I am to get my NCI here now, I'll get the NCI for this RUA. I'll get it at the date of acquisition, right? And I'll get the one for post acquisition, right? Am I right?
Yes.
So how do we get post acquisition? We get post acquisition after deducting consolidation from acquisition.
Yes.
Is that not so? If
Sir.
that is the case, the post acquisition profit here, the difference between 3,200 here and 2,840 is what? 400.
360.
No, it's not 360. This one minus this one. 3,200 minus 2,840. No, no,
360.
no. It will be 360, right? Now the
Mm.
360, yes, it will be 360. Of course, yes, it will be 360 because that means we still have an adjustment here. This adjusted
Yes.
profits, right? Okay,
Yes.
now it will be 360. But this post-acquisition profit, if you are looking at NCI at the date of acquisition, what's the NCI at the date of acquisition? We got 568,
Yes.
right? Okay, now let's leave whether 568 or not. Acquisition and post-acquisition should give me consolidation. If I had acquisition and post-acquisition, it's just like saying that I had what I have yesterday and no, what I had on Thursday and what I had today, right? If I had it together, or no, I'm thinking of how to get my post. So let's say I bought the company yesterday and I made a profit of 2 million naira. I bought it at 5 million. We made a profit of 2 million naira. 5 million plus 2 million naira will give us what our financial statement will be. What our financial state will be as of today. Abi? So acquisition and post acquisition. Acquisition is before, post acquisition. Yes. Acquisition is what they had before we got there. Post acquisition is what we made together after we got there. Only the profit. Right? Now, when we add post acquisition to your acquisition, it will give you the current state. Right?
Sir.
Aha. So that's it. So you can get your NCI from your consolidation as well, from the date of consolidation. Do you understand?
Okay, sir.
Yes, you
Okay,
can
sir.
get it. Instead of adding, and ordinarily, had it been we had a straightforward question, of course, we still fine tune our post acquisition profit to get
Mm.
that NCI. All
Mm,
right?
this year, yes.
Yeah, so don't worry about that. Now,
Okay, thank you.
we've taken information 3, right? Information 4 says that Rural Limited had purchased a significant amount of what? Of new internet equipment during the year. Abi? And the cost of that asset is what? Eh? The cost on that asset. Is anyone reading it for me? Hello?
So is this the question for?
Yes, I'm reading question 4,
Okay,
Roman
that's
figure 4.
200 million.
The cost before the trade discount. You know we have cash discount and trade discount. When do we issue trade discounts? And when do we issue cash discount?
Trade discount is when a customer buys goods in large quantity.
Okay?
Cash discount is for immediate payment
Okay.
when they pay shorter than
Cash.
the
For
agreed time.
cash transaction, right? Whether they pay immediately or they pay within the window. Abi?
Yes, sir.
Aha. Now, the price, the cost price of that equipment before trade discount is 200 million, and the trade discount was 24 million. Do we understand?
Yes, sir.
Yes,
The
sir.
trade discount of 24 million was taken to the income statement. Depreciation is charged on straight line basis over 6 years period. What does that tell you? What does that say, please? What does it mean?
We'll have to depreciate the assets.
We have to depreciate the asset. How? What do we need to do? I want to understand.
The cost of the asset will also be the cost before the trade discount less the trade discount.
Hmm.
Since the trade discount was an income, we did not spend that 24. So that means the cost of the asset in our books will be 200 minus 24. That's 173. It'll be 160. Is it 173 or 163? It'll be one.
Okay, so this is no. Now let's look at it this way. You don't understand the question. The question says that they purchased it at 200 million, right? Before discount. That is not the issue at hand. The issue at hand is that this trade discount of 24 million was taken to the income statement, right? And depreciation is charged on straight line basis over 6 years. Trade discount of 24 million is charged. When did we purchase the asset? They said Rua Limited purchased during the year. What year? What year are they referring to? What year are they referring to? Oh God. We don't understand
2020.
this question. Eh?
2020.
Okay, now 2020. When did we purchase Rua Limited? We purchased Rua Limited in 2017, Abby. Am I right?
Yes, yes.
Okay. Now, the trade discount itself, if we purchased it now, we need to understand this depreciation. What was it? What is it referring to? The depreciation is for what? And what is the group policy? What's their PPE depreciation? What's the number of years? If they are depreciating on a straight line basis, what's the number of years? The policy is to state PPE are depreciated historical cost. The group changed from revaluation to cost model, right? In the year 2020 and restated all its assets, historical costs in that year, except for the PPE of Millie and that had been revalued by the directors in 2019. The value were incorporated to be 280 million. I mean, fine. Now the PPE of Millie were originally purchased at a cost of 1.2 million. The assets are depreciated over 6 years. So which means now, don't forget, we are talking about the group policy now, Abi. So whatever Emily is using is what we are also using. Do you understand?
Yes, sir.
Please, do we understand? The group policy
Yes.
is that it works for all of them. So if the group policy is to depreciate assets of 6 years by 6 years, right? Straight line basis. Now, who purchased this 24 million? It was Rua. Now, when was it purchased? We were not informed. I mean, they just said during the year. So we can assume that during 2020. I mean, now the PPE of Emily was purchased on December 2018. Now, if you are looking at it, let's come back to this. If the asset is on depreciation of 6 years. Number of years to be 6 years, right? The number of years is 6 years. Now, the question told us that this 24 million, the trade discount was taken to the income statement. Depreciation is charged on straight line basis. Hello?
Alright.
Hello? Before the trade, before the trade discount, the cost was 200 million. Why the trade discount is 24 million, which was taken to the income statement. Abi? Now, the question is this. How do you recognize asset that has trade discount? How do you recognize such an asset? I'm asking you, how do you recognize such an asset? Yes, an asset with trade discount, how do you recognize it? Do you recognize it using the total amount or excluding the trade discount? For those of you who attended our last class, we said something like that. Hello?
We'll exclude.
We have to exclude the trade discount, right?
Yes, sir.
Yes, sir.
Yes.
Yes, sir.
Okay. Now, excluding the trade discount means that you are using only the cost. Abi? So if we are not using the trade discount, what do we use? Now, this trade discount, are we saying that the whole 24 million was taken to the PPE? 24 million, normally, Rua purchased this equipment. The cost is 200 million before discount. After discount would have been 224 million, right? Right? Am I right?
Yes.
So
Yes.
what if this question says that this 200 million, the trade discount was taken already to the income statement of 24 million, right? Now, the depreciation is 6 years. Why do we need this information? Does it mean that this trade discount of 24 million was depreciated and taken to income statement? Or does it mean that, does it mean that 24 million was added to this 200 million and then 224 million was depreciated based on 6 years basis? Eh?
Yes, sir. I think I'll go with it was depreciated on 6 years basis.
So the 24 million was added to 200 million, right? Now, ordinarily, the 24 million was to income statement because it is a discount, right? But in actual sense, the 24 million was depreciated on 6 years basis, whereas the 24 million is not supposed to be depreciated. Do you understand?
Yes.
Now, 24 million depreciation, 24 million divided by 6 years will be what?
4.
4. 4 million,
Yes,
right?
sir.
Now, which means
Yes, sir.
only 4 million for this year was recorded in our income statement. Hello?
Yes, we are here.
I'm with you, sir.
Eh? Only 4 million was taken to the income statement. The remaining 20 million is still in the financial statement. I mean, it's still in the financial position, which is not meant to be there. right?
Yes.
Aha, it's not meant to be there. The remaining 20 million is not meant to be in the financial position, but only 4 million was taken to income statement. The remaining 20 million is still in the financial position, and we have to remove the financial position. Do you understand? Do we understand that now?
Okay, sir. So we are removing it from the cost of the assets.
We are removing the 20 million from the net asset, from the PPE generally.
Okay. Okay.
Do you understand? So
Yes.
which means the the information we have on our PPE here, our PPE of 2020, this information has that 20 million as well as part of it. Do we understand that, please?
Yes, sir.
Aha. Shall we do that now?
Yes.
Okay.
Yes, sir.
Okay. Now, what do we now call the name of the asset now? What do we call the asset? Eh? You don't know.
TPP.
No, it's not PPE now. It is trade discount.
Okay.
It is a trade discount that has been depreciated, right? Only depreciation, one depreciation has gone out of it to the income statement. So we can say the depreciation, the trade discount will now be, how did we get it again? 24 times 24 divided by what? Divided by 6 years,
6
right?
By 6 years.
yes,
That will
sir.
give us that will give us 4 million,
4
right?
minus 24.
You can do minus 24 or times 5. You can do minus 24 or times 5, right? Out of 6 years, one has gone out. We have only 5 left, right? And this one will give us 20 million. That 20 million has to leave our financial statement as well. Do we get it, please? Do we understand that?
Yes, sir.
Okay.
Yes,
Now,
sir.
is there any other thing we have? Let's go into our information again and see if we have another information. And this, don't forget the trade discount. Don't mix it up or don't put it under milli. We understand it's not for milli, right?
Yes.
Okay. Okay. So now, let's go for the next information. So we have our historical cost, Abby. Hello.
Yes, sir. Yes, sir.
Okay. We have our historical cost. I think we've taken this information 5. Have we not? Have we taken it? Let's check it again. Now, the group policy. Okay, we have PPE for Emily here as well. Let's check if there's anything. The group policy is that IS 16 PPE November 2020, they restated it to historical cost, right? All of this. Now, the value, okay, let me take it from the group changed from revaluation to cost and restated all assets to historical cost in that year except for PPE of Emily, right? Now, when we were doing our restatements, we restated all our assets except for our PPE. For the PPE at Emily, right? Are we there? Are we there,
Yes, we are
please?
with you. We are with you, sir.
Okay.
So we're with you.
Now, except for Emily, we restated all our own. But Emily left its own, which had been revalued by the directors on the 1st of December 2019. The value were incorporated in the financial records, creating a revaluation surplus of 280 million. Right?
Yes.
We have a revaluation of 280 million. Now, The PPE of Emily Limited were originally purchased on December 2018 at a cost of 1.2 million. Right? Now, initially, the asset was purchased at 1.2 million in 2018, but the assets are depreciated over 6 years. 1.2 million divided by 6 will give us what?
200.
Eh?
200.
200 million. Now, the group does not make an annual transfer from revaluation reserve to retained earnings in respect of excess depreciation charge on the revalued PPE. There were no additions or disposal of the PPE of Emily Limited for the 2 years ended December 2020. Now, we purchased the asset in 2018 at 1.2 million. The depreciation for that 2018 will be how much? So now we have two different bases in the question. If we are using revaluation and we are using historical, which one works for us?
Revaluation. Revaluation.
You can't say revaluation or this thing. Don't forget, the company is not using revaluation anymore.
Okay.
It's only Emily that is using revaluation. Right?
Okay, it's true. Since we're incorporating the email.
So Emily is the only one using revaluation. But are we using the revaluation with Emily?
No.
So let's see the fair value there. All right. We might need to adjust our fair value if the fair value is too much or too less. Yes, Emily is adjusting its own, right? It's using fair value. Am I right? Now,
Yes.
what do we do? Let's check it. If the cost of the asset, let's just do it straight. Let's do it straight. Now, let's have that workings here. All right. If you are using valuation, revaluation, I mean, and what? Costs. Historical cost. All right.
Yes.
Let me bring this million naira here. Now, what was the cost of the asset at when? When was it purchased?
2018.
December 2018, right?
Yes.
Yes.
What was the cost?
1, 2.
So by revaluation also, it will be 1,200, 1,200, right? Now,
Yes.
what was the depreciation?
200.
Straight
Depreciation of
line.
2018 will be what? 200, Abi?
Yes, sir.
Abi, minus 200, minus 200. Is that not it? So
Yes.
ordinarily, this is our net book value, right?
Yeah.
Which is at how much?
1
1,000,
million.
right? Now this is, should I call it net book or carrying amount,
Yeah, this one was
right? Now if this is the carrying amount, when was it revalued? When was the asset revalued?
It was
The
also the
PPE of Millie were originally purchased in 2018 at a cost of 1.2.
December
The asset is depreciated
2019.
on this. The group does not make annual transfer.
2019.
When was it purchased? It was purchased in 2018, right? When was it
Yeah.
revalued? When did we bring in that revaluation method?
December 1, 2019.
2019.
December
This is
1.
it, right? Except of
Yes.
Emily, which had been revalued by the directors in 2019. Now, as at 2019, what's the value of the assets?
Two,
Revaluation.
280.
Eh?
280.
It was
280.
revalued to 280.
Yes.
20 surplus.
I don't understand. 280 surplus. Revaluation surplus.
Yes.
Please don't express my brain. Oh. Revaluation
So
surplus. And
Surplus.
let's be sure of whatever we are saying. There's a difference between revaluation and revaluation surplus. Am I
Okay.
right?
Yes.
So you will not say revaluation is also revaluation surplus. It's not the same.
Okay. Okay.
So the revaluation now, the revalued amount now is what? But this one is historical cost. We don't revalue. Abi? Since it is a surplus,
1,280,000.
that means we have 1,280,000 for this. Why this one
Yes.
remains 1 million?
1 million.
Abi?
Yes.
Okay. Now, at 1,280,000 in 2019 to
Yeah.
2020, that's another 1 year, right?
Yes.
What will be the depreciation? We'll depreciate it now, Abi?
Yes.
So depreciation will be what?
Sorry, what is the depreciation rate? Let me ask.
Depreciation is straight line basis, right?
Okay.
And it was
Okay.
6 years. We have
Okay.
used one of it. It remains 5 years, Abi?
Oh yeah.
So it will be 1,280 divided by 5.
256.
I think I should bring this in here.
256. 256.
1,200 divided by 6, so that we can see it anytime we want to go back to it. Right? I think that
Yes.
will be better. Then this one is what? 1,280, right? Divided by 5.
256.
256.
Yeah.
And do we have anything for this one? What is the precision under this one?
Should be
200.
It will be what? 200, right?
200.
Which is 1,200 divided by 5. I mean 1,000 divided by 5. 200. Abi?
Yeah.
So if this is 200, what's our carrying amount?
Current amount here should be 128. 256. 1,024.
1,024 and 800.
800. Yes.
1,024 and 800.
Yes.
Right? Now,
Yeah.
what's the difference?
Should
Our
be
depreciation has a difference of what?
224.
No,
224.
no. Our depreciation has a difference of 256.
Mhm.
Right? This one is 200, this one is 256. Abi?
Yeah.
Am I right, please?
Yes.
Okay. Now, 256. Sorry, please. Sorry. Now, 256. So what is our... Do we have any revaluation? We have a revaluation surplus in 2018. At the end of 2018, Abi?
Yes.
Am I right? This is carrying
Yes.
amount for 2018.
Yeah.
Abi?
Yes.
For December 2018. And this is the new amount, new carrying amount for December 2018. Abi?
Yes.
Am I right, please?
You're right.
Okay, so let me not use this one at all, since there is a
Should be carry
revaluation
amount.
surplus. So now the carrying amount for 2018 is this, or the opening amount for 2019. Yes, of course.
2019. Yeah.
So this will be our carrying amount for 2019. Abi?
Yes.
Okay. So if this is the carrying amount for 2019, yes, what do we have? In 2018, we have a revaluation surplus, but we don't have
Yes.
it in 2019.
Yes.
That revaluation surplus, was it considered?
As what?
Was it considered in the financial statement of RUA? I mean, sorry, Emily.
No, sir.
And should we go to the question so that you can understand
Let's
that?
go back to the question. Now, the PPE.
Yes, it was considered.
I'm coming. Let me write something here so that we don't confuse it. Property, plant and equipment of Emily Limited. Now, this 280 revaluation surplus, let's
Yes.
confirm if it was considered at all.
You can
It
Now,
assess
was
they
the
said
considered
that,
in the
what do you say? What do you say, sir? I can't hear you, sir. Okay, I thought the person was talking to us. Now, this revaluation surplus, the revaluation surplus of 280, was it considered? Let's check. All right, that's one
yes,
thing. And it was considered.
It's in the financial statement, yes.
It's in the
Let the
financial
director
it's
statement,
share.
but
negative.
where is it?
Yes.
Where is it? At a cost. Now, the group does not make annual transfer from revaluation reserve to retain earning in respect of the excess depreciation charge. Right? There were no addition or disposal. Okay, fine. It was considered. They don't transfer it to retain earnings, so it was considered. Now, coming down to this, our depreciation again. We have 256 here. We have 200 here. Now, don't forget, Emily has to come back to historical costs. Can you hear me?
Yes, sir.
Yes, we can
Yes.
hear you.
Emily has to come back to historical costs, right?
Yeah.
Am I right, please?
Yes,
Hello?
yes.
Emily has to come back to historical costs, right?
Yes.
Now, Emily currently uses revaluation, but now that we are together, it has to come back to historical costs. So if it is coming back to historical costs, definitely Emily has overcharged us. The depreciation for the year of 256 has been overcharged. This 256 is an excess depreciation it has charged for the year.
Okay.
Because ordinarily, if Emily was using the normal, what's it called?
Historical cost.
Historical costs, there would have been
Yeah.
nothing like this 280 revaluation surplus in the first place.
The first
And
place.
then there will be
Yes.
no need for this 256,
Yes.
right? So
Yes.
if that is the case, it means that Emily has excessively charged the account of 256 million instead of 200 million. The difference between them is what?
56.
56 million. That 56 million is an excessive charge of depreciation.
Okay.
Do you understand? That depreciation, we need to bring it back. And depreciation will reduce your financial position. Am I right?
Yes. Yes.
Depreciation will
Because
have two effects,
yeah, to reduce the cost there.
right?
Yes.
The depreciation will reduce the cost of your assets.
Yes.
Okay, so if that is the case, let's bring it back. What is that, self? Excess depreciation. Excess depreciation on revaluation model. So what do we have there? What's the excess
50,
depreciation now? 256
50,
minus 200, right?
56.
That's 56. And it is not for this person, no. It's for Imiri, which is
Yeah.
56. Do we have any question, please?
So the excess depreciation,
Yes.
are we going to add it, or we have to to subtract it from the original cost?
Depreciation will be deducted from the value of PPE, from the value of your asset to arrive at carrying amount. Abi?
The assets. I'm
I
talking
know. I'm
about the
trying to bring it back. I'm trying to remind you. Depreciation. What do
okay.
we do to depreciation in financial position? We
We
less
use it to
depreciation from the cost of the asset.
from the cost of the asset. Yes.
So that means this 56,000 has been deducted already.
Okay.
So we need to add it back
Add it back. Okay. Good.
to increase the value of the asset.
The assets. Yes. Thank you.
Any question from anyone, please? Any question?
You can carry
No
on. No? I
question.
don't have a question.
Okay. Now let's check the other information if there is anything again we have not picked. It is the group policy to value NCI at acquisition at their proportionate share of subsidiaries identifiable net assets. Hello. Hey.
Yes.
See the information here. We have to value our NCI at what? Identifiable net assets, not on fair value. If it was on fair value, they would have given us the fair value now. I mean,
Yes.
but they didn't give us the fair value. All right. So that's it.
Yes.
So what do we have now? Now, all this that we have are the net assets at the date of consolidation, Abi.
Yes.
Is that not so?
Yes.
Yes, sir.
Is it at the date of consolidation or at the acquisition?
Our NCI, the information we have been picking so far is at the date of acquisition now.
Good. You can go on.
I want to check something.
Okay.
I want to check this. Now, this revaluation, they said, where is the million? The value were incorporated in the financial records, creating revaluation surplus of 280 million. Right?
Yes.
Now, we are using historical, but Emily is using revaluation, right? Which is at 280 million. Now, that 280 million, the PPE of Emily were originally purchased 1,200. The assets are depreciated over 6 years. The group does not make annual transfer from revaluation reserve to retained earnings.
Yes.
Right? Now, if we are not taking this, this amount, don't you think the value of our asset will still be over bloated?
If
Because
we are not taking which
now,
amount, sir?
in the account of Emily, this is what we have in the account of Emily. The value of assets in the account of Emily is this figure. Am I right, please?
Yes.
Is this figure. Now, Emily has included revaluation surplus in his account. This
Yes.
2.80 million has to be removed
Okay.
before we can come back to historical cost basis.
Yes.
The difference between these two, right? What's the difference?
Should be
This minus this is 224, right? Now that 224, this 256, this is 56,
yes.
right? Now, if you are looking at this, if in the account of Emily, we are using revaluation, Emily has included this revaluation surplus in its account. We must remove it.
Okay. Why? Sorry. Why are we removing it?
Because we are not using revaluation model.
Okay.
We are
For
using historical model.
Okay.
And
Okay.
Emily
For
has recognized revaluation surplus. So if you look at this, the difference between this place and this
Yeah.
place now
Yeah.
is this 280,
Yes.
right? And that was why the depreciation was also at 256
Yes.
as against 200. Now, we took only 200. We left 200 as depreciation and removed only the 56,000, 56 million, which is the excess,
Yes.
right? In the
Yeah.
same vein, this 280 million should not be in the account at
Part of
all.
the. Okay.
The 280 million should not be there.
Okay. Thank you. So
Do we
where are we
understand that,
taking
please?
the 280 million? Where are we taking it to?
It's already included in Emily's financial position. This financial position we have here for Emily, PPE.
Okay.
Where
Okay.
is it? The PPE for Emily, this 1024, you can see.
Yeah, it's inclusive of that. Okay.
This
Good.
is 1024.
Okay.
This 1024 has this 280. We have to remove it.
Okay.
Do you understand that?
Yes, I
We
understand.
just did a walk back of how Emily got its own 1024,
Yes.
right?
Yes.
Whereas what Emily is supposed to have is 800, not 1024.
Okay.
And what resulted to that is because of this 280 and also this 256.
Yes.
Do we understand? So the
Yes.
256, 1280 was divided by 5.
Okay.
We have brought back the difference between the depreciation of 200 and 256, right? This one
Yes.
also, the difference, this one is equal. So we don't have any issue here up to this place,
Yes.
right? We started
Yes.
having the difference here, which is this
Come.
280. This 280, we need to remove it as well because we are not supposed to recognize the revaluation surplus.
Okay.
Do we understand?
Okay.
The recognition of revaluation surplus.
Yeah.
How much is it? 280. We
30.
have to derecognize it.
Okay.
Do we understand that, please?
Yes.
Now let's check the last information. We've taken information 6. During the year, there is a defined benefit plan of 400 million, right? Parent
Yes.
company and contributed cash to 400 million. That's our asset. Then we have the present value of obligation and all of that. All of this will not affect our NCI. Abi,
Yes. Yes.
this will not affect our NCI because it is in the book of OMI PLC, not in the book of the subsidiary, right?
Yes. Yes.
Aha. So that's it. So that means we don't need to do that. Now, let's check in the absence of any other information. What do we have in total?
Give me that light. I mean, that touch. Not enough. Don't worry. No.
What do we have in total? This one is 2,700 and the other one is 1,296.
Okay.
2,700 and 1,296. Right? So
Yes.
now I'm using the date of consolidation, not the date of acquisition and post acquisition. All right?
Yes.
Not the date of acquisition and post acquisition. I'm using the date of consolidation as given to us in the financial statement. All right? Now, what is the NCI in this question? How many percentage did we purchase in RUA?
80%.
680, Abi?
Yes, sir.
Yes.
So NCI will be at what percentage here?
20.
20%. And NCI here will be at what percentage? What's our total this thing? Total ownership of Omi to Imiri is 60%, right?
Yes.
So that means our NCI will be at 40%.
40.
So whatever this is the value, this is the net asset. This is the value of the net asset at the date of consolidation. We removed all of this. This is the net asset at the date of consolidation, right?
Yes.
Investment in RUA is part of this 3.2 million, right? We had to remove investment in RUA. Development cost was included in financial position by RUA, whereas we had to expense it, so we expensed it again. Trade discounts, only 4 million was sent to the income statement. The remaining 20 million as well is going back to that income statement, right? Now we have a depreciation on revaluation that has been an excess of 56 million in the financial position. In the financial position of what's it called? Emily, right? So now that depreciation, we need to bring it back because depreciation is usually deducted in the financial position. So we added it back, and also revaluation surplus has been included. We need to remove it as well, right? So that's it. So what is our NCI now? What will be the NCI?
540.
This times 20%, I mean
20%.
540,
Yes.
and this one is
516.
518.4.
times 40%, right?
Yes.
518.4, right? So our total NCI is what? Equals to this
1005.
1058.4.
1058.4. 1058.4. So that's our NCI. Can we still do retain earnings today?
Yes, let us
I
continue.
don't think so. Okay.
Let us
Okay.
do it.
Can we do retain earnings today?
Let us do it.
Yes, sir. Let's do it, sir.
Let us do.
We should do it, ba?
Let us do
Yes, sir.
it.
Okay. So let's do our retained earnings then. So what's the retained earnings given to us in the question? Calculation of retained earnings. Yes, what do we have as our retained earning?
Omni.
So let's take for the three of us now. How do I always forget this thing? Sorry, please. So the calculation of retained earnings. All right, yeah. What is our retained earning?
As per question.
Yeah, as per question. Retained earning at consolidation. Retained earning at consolidation is how much?
Let us go back to the question so that can.
Oh, okay. Retained earnings, yeah. We have 500, we have 800, and we have 240. Abi?
Yes.
Okay. 500, 800, and
800,
240.
240.
Right? Okay.
Yes.
Now, in this retained earning, here's what we have. Yes. What do we have? We have fair value adjustment here.
Yes.
Abi?
Yes. Depreciation.
Abi? The fair value
Yes.
adjustment is on whose account?
What's about to pay it?
Rua's
Ruler.
account, Abi?
Yes.
Okay. Now that fair value adjustment of 40, have we taken it? Shall we proceed, please?
Yes, sir.
Okay. Now we have a fair value adjustment. All right. And our fair value adjustment of 40, right, which is in Rua's account, has it been considered? Eh? The fair value adjustment, is it part of our at the date of consolidation?
No.
Okay. So what do we do to the fair value adjustment? What do we do?
Reless it.
We less it. Thank you. So we have our fair value adjustment. How much? We don't have anything here.
40.
40.
Minus 40, and we don't have anything here. Then what else do we have? Now, this development cost that we wrote off, right? Am I right? It's part of the NCI. Am I right? The trade discount.
Yes, sir.
Hello,
Yes,
this
yes,
trade
sir.
discount as well that we have for Emily,
No,
right?
Ruler.
Sorry, trade discount for Rua, right? Then
Yes.
also the what again? The 56 excessive what's it called? Revaluation. Should be to affect all of us now.
Yes, sir.
Am I right? It will affect all of us,
Yes, sir.
right?
Yes, sir.
Okay. So now let's take the three of them again. The development cost and everything is affecting this Rua alone. Development cost for Rua is how much? 80. Abi?
See. Yes.
80. There's nothing here. Trade discount here was 20. Abi? There's nothing
Yes.
here. Excessive depreciation was how much? 56. Right? Then what else do we have? What else do we have? Hello? Hello?
Well, with you, sir.
Okay, so our retained earnings now, right? We've done all of this, right? Now, don't forget the information we are picking is at the date of consolidation. The 240, 800, and 500 is the retained earning for these two people we are picking. Ordinarily, our focus should be on our own retained earning, which is 500, right? And whatever retained earnings these people have, whatever retained earnings they have, that is, retained earning at the date of acquisition and at date of consolidation, am I right? Is what we are to have our own share from. Am I right, please?
Yes, sir.
Yes, sir.
Okay. So now, what is the retained earning? We need to remove the retained earning at date of acquisition, right? Because ordinarily, now what are we done here? The retained earning simply means that in their retained earning of 800 million, they factored in this adjusted fair value adjustment of 40, Abi,
Yes.
which we have to remove. The development cost has been factored in. The trade discount has been factored in. Excessive depreciation has been factored in. So we need to remove those ones that have been added and then add back those ones, the one that has been that was removed, right?
Yes, sir.
Uh-huh. Now that's what we are doing here. So now the if you now look at it, that means the actual net asset, I mean the actual retained earnings at the date of consolidation is 660 for Emily, I don't know why I used this. So, or I can just say that I'm taking 80% of it, right? I'm taking 80%. 80% of it belongs to me, right? And this one is 60%,
60. So
right?
you rest 800%.
Sorry?
You type 800%.
Oh, okay, sorry. Now, what is the net assets at acquisition for the two of them? What's the net asset at
100
acquisition?
and
I mean, the
200.
retained earnings at
Yes.
acquisition. Retained earnings here is 400 and this one is 200, Abi?
Yes.
Uh-huh. So the retained earnings is minus 400 minus 200, right? What's the retained earnings now? We have all of this, right? Now, the total retained earnings for OMI PLC. OMI is the only one using PLC, Abi? Abi? OMI is the one using PLC. Am I right? OMI is using PLC. Now, total retained earning now will now be for OMI, right? Hello?
With you, sir.
Okay. So let me just not underline this. Retained earning, share of retained earning. A share from Rua Limited at how many percent again? 60, 80%, right? What does Rua Limited have? 260. 80% of 260 is what? This times
208.
80%. That's 208.
208.
What else do we have? Share
60.
from Emily. At what percentage? 60.
60.
Yeah, that will give us what? This times
57.6.
57.6. Abi?
Yes, sir.
Now, in our retained earnings, in our retained earnings, we have an information earlier that I said we should leave for now. Now, in our retained earnings, right? Where is this information? Where? This last information we have. Are we there? The information 7.
Yes, sir. We are with
Yes.
you, sir.
Okay. Now the information 7 talks about it talks about our employee benefits, right? So what should be in our financial statement in our employee? What is our employee benefit that will go into our financial statement? Are we there? That will go into our financial position because that's what we are preparing here. What aspect of our pension is going? Now, the first thing we have is that we have the present value of our obligation to be 520 million, right? Hello?
Yes.
And the fair value of the plan asset is what? 500.
500.
What will that give us? Can we net it or not?
We come.
We can net it, right? So
Yes, sir. 200.
we can have a net obligation or asset, right?
Yes, sir.
Please, do we understand what we are saying?
Yes, sir.
Hello?
We are with you, sir.
Okay. Now, let's get our what should be our what do we call it again? What's the name now? Uh
Pension.
Define pension. Define benefit scheme. Is it a
Yes, sir.
benefit or contribution? Is it defined benefit or defined contribution? Eh? Me, I'm just asking. No. It is a defined benefit pension scheme. Defined benefit pension scheme. That's what we have in our financial, in our question, right?
Yes, sir.
Yeah. Computation of defined benefit pension scheme. Yes, what do we have under it? We have our dollar naira, our million naira, right? Now we have our defined obligation, right? Present value of obligation, PV of obligation. How much? 5 what sef? 520, right? Then we have
Yes, fair value.
fair value of assets. What do we have? 500.
500.
Sorry, right?
500.
That will give us a net liability, right?
200. Yes, sir.
20, yes.
20.
20, please. 20. That's 20. The 20 is a liability, right? Am I right?
Yes, sir.
Okay, so this
Yes, sir. Yes,
20
sir.
is a net liability, which is our pension, Abi, right? Pension
Yes, sir.
net
Yes, sir.
liability. Okay, now, after this liability, what figure do we have in our income statement? What will be our expenses on this information? All right, now, the pension in our P&L, what will be the pension in our P&L? And why do I need the pension in our P&L? Now, the reason is this. The company in the question says that the only entry in the financial statement made to date is in respect of the cash contribution. Only cash contribution has been recorded. Do you understand? So we need to record the figure itself, like the one that goes into the financial liability, I mean, in the financial position, and the one in the income statement. Now, the one in the income statement now, we can prepare our income statement, but it will affect our net profits, Abi. Am I right?
Yes.
It will affect our
Yes.
net profit. So what is that net profit? Right? And our net profit will go into our retained earnings in our financial position. So that means our financial position retained earnings. That figure, we need to include it. If we have more retained earnings going there, we should include it. If we have less, we should also state it as well, right? So how much is going to our income statement? What are the figures for income statement? We have the current service cost, Abi. We have the interest cost as
Interest
well,
cost.
Abi.
Yes, sir.
Then we have the
Yes, sir.
expected return. Am I right? We have the
Yes, sir.
actuarial
Yes, sir.
gain. All these are income statement figures, right? Am I right, please?
Yes, sir. Yes, sir.
Okay, so let's see whether it is plus or minus. So what do I have first? What did I call it first, Jerry? And the first one is current service cost. How much is the current service cost again?
440.
440. What else do we have? Interest.
Interest cost.
How much?
8.
80.
80.
80.
That one is also a cost, Abby.
Yes.
Yes,
Okay.
sir.
Then we have expected return on pension assets, right?
Yes, sir.
Yes.
Expected return. How much is our expected return?
40.
40.
So it is an expense. I mean, it is an income. So we should less it from the
Income.
expense. Then also, what do we
Mm.
have? Actuarial
Actuarial
gain.
gain.
Actuarial gain.
How much is our actuarial gain?
60.
60. We should also less it from there. Any other expense? No. So what's the
That's
difference?
all.
What do we have in total?
420.
So we have 420 that will be transferred to our P and net profit, Abi. Now this
Yes, sir.
this 420 is an expense, so it will reduce our net profit, Abi.
Yes, sir.
Please, am I right?
Yes.
Yes, yes.
It will reduce our net profit. So if it will reduce our net profit, this is net expense, right? Which will be transferred to when? To where? Retained earnings.
Let me.
Am I right?
Yes,
So
sir.
it is a
Yes.
lot in our retained earnings. So that means we still have that one is from our account. So, Abi, is it not from our account? It's from our account now, right? So let me charge that one to our account, right? Let's what? Our defined benefit pension, Abi. Benefit pension. The defined benefit pension scheme gave us 420. Abi, am I right?
Yes, yes, sir.
Now, this one is a liability which will be recognized in the financial statement. Abi,
Yes, sir.
Yes.
am I right? It will be under our non-current
Yes.
liability. Is it a non-current liability or a current liability?
Current.
Current liability. Okay, so it will be under liability. We are still coming back to it, but this one will affect our retained earnings, right? So what's our total retained earnings here now? Yes, what's our total retained earnings? Hey, total retained earnings now is 2000.
345.
Total retained earnings for Omi Limited. 2003 what?
45.6.
345.6. That's all. Now this is where we hang our boots tonight. I'll see you all in our next class, which is on Saturday, next week Saturday. And if there will be class on Friday, I'll let you know, but I'm not sure yet.
All
All
right,
right.
sir. Thank you, sir.
You're welcome. Good night, everyone.
Have a good night, sir.